Well, let's stay on bonds. Let's bring in our first guest who says the two dominant trends of this year will be a weaker dollar and a steeper yield curve. Joining me now is Schwab Asset Management CEO and CIO, Omar Aguilar. Omar, it's great to have you back on the show, and let's start right there. Why is that your thesis?
Yeah, our fixed income research team, has done a lot of work on, how these things, have operated. And let's start with the basics of, where the economy is. So the economic, backdrop on where that drives a lot of the yields and the activity in bonds, has these cross currents, that have, on one hand, the tariff uncertainty, the inflation and real rates putting a lot of pressure on future growth, and certainly forecasting and potential slowdown in the U.S. economy. And on the other hand, you have, the expansion of fiscal stimulus, that can, propel capital expenditures together with consumer that is heavily resilient, that creates additional productivity and more profitability for companies. So when you have these cross currents, that only puts more pressure on what activities that central banks might do, as it was actually relayed before. So that puts pressure on the lower end of the curve. So as we anticipate potential activity in the lower end of the curve, the short part of the curve, we think that steeper yield curve, which has already occurred, continues to have. Now, the other piece that goes into the yield curve is the fact that inflation expectations have actually come down. Inflation itself is actually on a trending lower, not at the pace that the Fed may want to, but it's definitely on a trend down. What is actually coming down faster is those inflation expectations. So again, that puts a little more pressure onto that lower end and short end of the curve that maintains that particular piece of the yield curve to be steeper.
So why do you say this might be the summer calm before the storm then?
Well, a lot of what we are expecting is, we have seen incredible recovery in equity markets, a lot of that because of these, what I call resilient but complacent investors. In other words, investors have been in these or giving a lot of attention of trying to just understand and hope that things will continue to go well. A lot of the discussion about uncertainty around trade policy has actually gone into the fact that nothing has transpired directly yet on inflation, and nothing seems to be, at least in this part or early part of the earnings season, in profit margins. If you actually think about it, at some point, something has got to give. And in our perspective, while we don't necessarily know if these will basically be potentially positive or negative, we actually believe that more volatility is yet to come. As I said earlier, if these, fiscal stimulus translates into a higher cycle of capex, that could be incredibly powerful for productivity and profitability. That will potentially give an extra leg. So you can imagine the scenario that there is increasing capex, higher productivity, higher profitability with a Fed rate cut. That could be incredibly bullish for equities. On the other hand, if we see the continued pressure on tariffs, inflation is higher than expected, that could actually be the catalyst to go negative.
So what do you invest in right now?
So our approach continues to be in both in fixed income and in equities to stay on higher quality. Right now, our view is there's really no reason for anybody to be a hero. There is a lot of uncertainty still in the market. We have enjoyed, quite a bit of recovery of the last 3 months. I think going ahead, we continue to encourage investors to stay in, high quality companies with high profitability, hopefully that have high free cash flow yields, and companies that can pay dividends as a way for them to protect for future volatility down the road. We also, like the intermediate bonds with higher quality, mostly investment grade. There is really no reason to go into the high yield part of the market just yet. And again, take advantage of the fact that interest rates are still pretty attractive.